Hey everybody, and welcome to the first video for money and banking. Today, what we're just going to be doing is going to give some baseline concepts and jargon that you are going to be using through the rest of the course. So it's really important that you understand all of these terms. After this video, I'm just going to assume that you know what all of these words mean. So also please reach out if you're still confused on any of them. So as a brief overview, we're first going to be talking about financial assets and different types of financial assets. Then we're going to talk about financial institutions and the role that the Fed has with these financial institutions. And then finally, just a big picture, what does the financial system do? And this is going to be our compass for the rest of the course. So looking first at financial assets, at the very basic, an asset is anything of value owned by a person or a firm. So this could be the computer that I'm recording this on, my phone, laptop, or any stocks or bonds that I may own. Now, a financial asset is a subclass of assets, and a financial asset is a claim on someone else to pay you money. So that could be like a stock, bond, etc. Now, a security gets even more granular. A security is a tradable financial asset. So this is something that has some sort of value that you can also trade. And then finally, a financial market is some sort of institution that is set up to trade securities. Now, there are five broad types of financial assets, and we're going to be dealing with all five of these in this course. The first is money, stocks, bonds, foreign exchange, and then finally securitized loans. And first, talking about money. Now, I know when we say money, a lot of you are just going to think bills, coins, etc. However, in economics, we actually use a bit broader term for money. And we use the definition of anything that people are willing to accept in payment for goods and services or to pay off debts. And we're going to talk about the money supply or the supply of this money in chapter 2, but that is the total quantity of money available in the market at any one time. Now, stocks, or what we'll also refer to as equity, is something you also are probably pretty familiar with. But for those of you that don't know, a stock is just purely a partial ownership of a corporation. So let's say that I own one share of Apple stock, and Apple has 6 million shares outstanding. Then in that case, I actually own 1/6 millionth of Apple. And then you can trade these stocks for a certain amount of value. And you can derive the value of the stocks based on what somebody else is going to pay for it. However, there's also another way that you can get value from stocks, and that's through dividend payments. And dividends are just a fraction of profits that are divided up and paid to each owner of the company or shareholders. So, using the same example that I just gave, if I own one share of Apple, and Apple announces that they're going to give a 40-cent dividend for the third quarter, then that literally means that every single share will pay the owner 40 cents. So if I own this one share, I make 40 cents in the third quarter on Apple just by holding on to the stock. And if I own, 3 shares of Apple, then I get a buck 20. So pretty cool there. Now, bonds are just a fancy term for a loan, and they can either be private or public, private to another company or public to the government. And bonds are a bit tricky, so we're going to get into them more in depth later on in the course, but they have coupons, maturity rates, and term rates. So a coupon is just the frequent interest payments for a bond because nobody is willing to loan money for free. Any sort of loan, even if it's to the US government, has some sort of risk attached to it. And because of that risk, the person who's issuing the bond, has to pay some sort of premium. Right now, a US Treasury bond can pay, like 1 or 2%. So that means that if you buy, $1,000 of US Treasury bonds, then you get 1% on top of that $1,000. So you're going to get $10 of profit on that bond. And those are paid out in the frequent set coupon dates. Additionally, the maturity date is when the bond expires because you can't just give out a loan and have no expectation about when it's going to get repaid. That maturity date is when the entire bond is going to get paid back in principal or the initial value of the bond. That is the maturity. And then, just for our purposes, as well as some legislative and regulatory purposes, we refer to bonds being short term if they have less than a 1 year maturity date, and long term if they have greater than 1 year maturity. Now, these last two are going to be possibly a little bit less familiar for you guys. The first one is the foreign exchange market, or Forex market. And this just means that we're now trading in units of foreign currency. And the Forex market really exploded as companies started to globalize. Because if I own a company and I want to set up a manufacturing plant in China, I can't buy that warehouse, the plant, the labor, the materials in American dollars. I have to buy it in Chinese yen. And the Forex market is where I trade American dollars for Chinese yen to then buy all those materials for my company. However, people now also are very interested in the strength of different currencies against each other. So let's say I think that the euro is going to get stronger in compared to the US dollar. I may buy some euros on the Forex market to hold on to, hoping that it gets stronger compared to the dollar, and then trade it back for American dollars later on and hopefully make a profit off of that. However, this is all pretty obscure, so it's still usually only done by investment banks, and we're going to talk about that definition later on. Finally, and this is really important for this class, is securitized loans. And these are markets being made to trade the loans that we were talking about earlier. And the way that they do this is investment banks convert loans to securities or tradable assets through a process called securitization. And the most common example is with mortgages. When you take out a mortgage on a house, that mortgage derives its value from both you paying back the principal as well as the interest that you pay on the mortgage. However, the person who issues the mortgage doesn't necessarily care about whether you're going to pay back the mortgage in 30 years or not. They want to get it off their books. And so what they'll do is they'll securitize it. And the most common way that is done is through the creation of mortgage-backed securities. And we're going to get into these more in the next video. But a mortgage-backed security is just an agglomeration of thousands of mortgages all together that is traded on a mortgage-backed security market. And the income from that mortgage-backed security is generated from the coupons and interest paid by the home payers. And then finally, just to kind of complete this picture of these different types of financial assets, for anyone that holds them, they consider it an asset. So any stock that I own is an asset. However, for everybody that considers it an asset, somebody else, the issuer, has to consider it a financial liability. Now, there are two different types of ways that we can trade all these different financial assets, and we do it through financial institutions. The first financial institution are financial intermediaries. The second one are financial markets. Now, financial intermediaries are people that are just market makers, that they're finding people that want to buy something and want to sell something. And the sellers sell it to the bank, who then sells it on to the buyer. So these are just financial intermediaries just setting up the market. Now, financial markets are just open markets like the New York Stock Exchange where people trade directly with each other. So anytime you want to buy common stock, again, let's say Apple, you usually are typically going to do that on, a platform like Robinhood or something like that. And when you do that, Robinhood is operating directly in the financial market. They are buying that share directly from somebody else for you. Now, looking back at financial intermediaries, there are two different types. There are banking and non-banking financial intermediaries. And banking ones are just what we classically consider to be banks, commercial banks. And commercial banks are financial firms that serve as a financial intermediary by taking in deposits and using them to make loans or to buy securities. So anytime you make a deposit with, your paycheck, you're doing it in a commercial bank, and that commercial bank in turn is taking the money that you deposit with them to give out, auto loans or maybe buy securities. However, there's an entire murky class that we don't commonly think of in financial markets called non-bank financial intermediaries. And the most common and recognizable one are investment banks. And these are completely different from commercial banks, and it's important to recognize the difference. When we talk about commercial banks, we're talking about, US Bank, Bank of America, etc. Investment banks are the big boys, Morgan Stanley, Goldman Sachs, etc. And investment banks don't typically take in deposits, and they actually rarely deal with households at all. Their objectives are to give financial advice, underwrite asset issuance, and securitize loans. And what I mean specifically by underwrite asset issuance, I mean that when a company buys out another company, let's talk about when PayPal bought Venmo. PayPal agreed to buy Venmo for a certain amount of money, and they did it with debt. If they have solvency issues, don't have the money on hand to pay off that debt, Goldman Sachs underwrote the purchase. So that means the owners of Venmo could hold Goldman Sachs financially liable if PayPal failed to meet their deal agreed upon value. And so, of course, Goldman Sachs is going to get some sort of premium for underwriting that asset. Insurance companies are a little bit more tangible. These are just people that write contracts to protect policyholders from financial losses. So anytime you take out an auto loan, housing or auto insurance, house insurance, life insurance, these are just people that you pay a premium to, who in turn, if something bad happens to you, they'll pay the expenses. There are a couple more types of non-bank financial intermediaries. We're not going to get to them quite as much. These are a lot more financial and finance-related topics. But if you are interested in them, feel free to talk to me about them, and we can go in depth more about them. But the first one are mutual funds and ETFs, and what they do is they sell shares within the fund or the ETF to investors, and then follow a stated investment strategy. So, for example, the SPDR ETF is an ETF or a fund that tracks the S&P 500 and buys shares that mimic the entire complexion of the S&P 500. And they raise the capital to make all those investments by selling shares of the ETF to investors. So if I own one share of the SPDR ETF, I have some fraction of my income that is just mimicking returns on the S&P 500. Hedge funds are a little bit different. Hedge funds are less regulated and they're very exclusive. So a hedge fund usually only has very large clients. Nobody can just, automatically buy into them, and they have some sort of financial manager who has been granted the power to make risky financial investments and are rewarded with very high fees. So hedge funds have a lot of power in the market, but most people don't have access to them. Now let's look at financial market classes. So first you have in-person tradings, and this is if you've ever visited the New York Stock Exchange on Wall Street or something like that. These are physical places where the financial markets take place. However, most financial trading is now done electronically, and that was initially designated as quote unquote over the counter. However, nowadays we more commonly just call it electronic. There are also different levels, another dimension to our market types. There are primary markets and there are secondary markets. Primary markets are where securities are sold for the very first time. So, for example, IPOs. If anybody has ever watched The Wolf of Wall Street, one of the big problems that Jordan Belfort ran into was he pumped up the price of Steve Madden shoes when they went public in the primary market through the Steve Madden IPO. So most of us will never deal with primary markets, and it's a little bit of a murky water on how to price them. Secondary markets are what we usually deal with. This is anytime you buy a stock, you are buying it on the secondary market. If I were to buy a share of Amazon tomorrow, I'd be buying it on the secondary market. So this is now just people continuously trading securities. Now, the Federal Reserve is really important in the overarching big daddy of the financial markets. And we often call it the Fed, and I'll often call it that in the rest of the videos. And the Fed is the central bank of the United States. It was established in 1913 and operates completely independently from American politics. So you can think of it as just a fourth branch of the American political system. And its job is only to regulate and deal with any problems in the banking system through what we call monetary policy. We're going to get more in depth on the tools that they have available in monetary policy later on. But broadly speaking, their ultimate objective is to control the money supply and interest rates for various macroeconomic objectives like controlling for inflation. And the policymaking body of the Fed is the Federal Open Market Committee, and it is comprised of the 7 board of governors, the president of the Federal Reserve Bank of New York, and then at any time it also has 4 presidents from the 11 other Federal Reserve District banks. So if you're doing your math at home, that means that there are 12 different district banks, each which have a different geographical region of interest in the US. So for example, I'm from Wyoming, so I am under the Federal Reserve Bank of Kansas City. However, here in Indiana, we're under the Federal Reserve Bank of Chicago. And so collectively, the Open Market Committee gets together, evaluates how the markets are doing compared to their monetary policy objectives, and then tweak their objectives and plans based on what they see. Now, finally, what does the financial system do? What are we talking about when we're talking about the financial system and everything coming together? And there are 3 main objectives that it gives investors. First is risk sharing, second is providing liquidity, and then finally providing information. And when I say risk sharing, if you've ever taken a finance class, you should all recognize the term diversification or diversify. For anybody to put all their wealth in one asset is extremely risky because I could buy all the stock of Amazon that I can tomorrow, and then next year you find out that there's some legal case against Amazon and the company goes bankrupt. It's very risky and can fluctuate a lot. However, if I own different shares of different companies, if one company has a big shock to it, the rest of my portfolio should still be smoothed out. And this is called diversification. So all I'm trying to do is reduce my risk along with everybody else so that we have a smoother income over time. And financial markets allow for a decentralized way for risk sharing between everybody participating in the market. Now, providing liquidity is also very important by the financial system because nobody wants to keep all their money in physical assets. It is a lot easier to sell stock than it is to buy a car, for example. And it also makes more sense in the financial system to invest in something than to just hold on to, stacks of individual dollar bills in my house. And so the financial system allows you to invest your money into something with varying degrees of risk and then in return sell that to quickly get liquidity when you need it. And then the final role that the financial system plays is provide information. And as you all should know by now, one market failure that has been identified by economists is when there's asymmetric information or people in the market don't all have the same information available. And what the financial system does is give a good way to make all information that is, publicly available for everybody. And they do this in a lot of different ways. And you get into the efficient market hypothesis, which we're not going to talk about today. But broadly speaking, prices and public information are available to everybody unless something illegal is happening. All of us should have the same access, if we wanted it, to financial information as an analyst at Goldman Sachs. And having this decentralized financial system makes that possible. And we're going to keep all these objectives in mind through the rest of the course. But that closes out this video. I hope you enjoyed it. And then you can now go on to the next video talking about a couple really interesting financial crises.